Hello everyone, and welcome back to the Web3 Daily. Let's dive into the latest market action. Bitcoin and Ethereum are currently in a technical consolidation phase near their highs, and the broader market seems to be moving sideways, gathering strength. However, even in this kind of environment, there are always a few standouts that chart their own course. Today's star is BNB. Driven by strong fundamentals, not only has it defied the broader market trend, but it has also hit a new all-time high. We'll get into the story behind that a little later. Alright, the topic we're diving into today is, without a doubt, the most explosive and heart-pounding story in the entire Chinese-speaking crypto community over the past 24 hours. A meme coin on the BNB smart chain called Binance Life. Guess what? In just 4 days, its market cap shot past 160 million US dollars. When I saw that number, I was honestly a bit stunned. The speed is just insane. But what's even more insane is the wild wealth creation myth behind it. A few well-known KOLs in our Chinese-speaking circle basically put on a live broadcast of achieving financial freedom. Let me read you some numbers so you can feel the impact. Started with $75,100. And now has unrealized gains of over $2 million, a return of over 2,600x. Wang Xiaoer put in $171,100 and has unrealized gains of $1.8 million, a return of over 1,000x. And the most ridiculous one is Shenzhen University graduate who turned $1,930 into $1.8 million in unrealized gains, a return of over 82,400x. Honestly, my first reaction to these numbers was, have the rules of the game completely changed? This is no longer the kind of meme coin we used to understand. The kind that slowly builds from the bottom up through community consensus. This is a whole new playbook. What I call the KOL as the project model. The KOLs aren't just the promoters anymore. They are the project. They use their own reputation and community influence to launch it directly. When fans buy the coin, what they're really buying is a vote of confidence in that KOL. This model launches terrifyingly fast. It doesn't need a cold start period because the trust is transferred in an instant. And the name Binance Life is just brilliant. It precisely captures the collective memory and identity of the massive Binance user base, the shared experiences through bull and bear markets, the desire for wealth. It creates a powerful emotional resonance right away. Added to that, the low transaction fees on the BNB smart chain, which allow ordinary people to join the frenzy at a very low cost, providing the perfect breeding ground for the emotional explosion that followed. But, friends, behind the carnival, the risks are enormous, and we have to stay rational. In this KOL-led model, there's extreme information asymmetry. The power to decide when to launch and when to dump is entirely in the hands of a few. The meme coin market is a zero-sum game, possibly even a negative-sum game. Where did the millions of dollars those KOLs made come from? It came from the money of the folks who rushed in later, driven by FOMO. So, when you participate in projects like this, you have to be crystal clear that you might just be paying for someone else's financial freedom. The phrase market risk needs to be magnified 100 times in the world of meme coins. This Binance Life experiment has shown us a new level of monetizing influence, but it might have also opened the Pandora's box. Now for our first major news story of the day. After talking about the wealth creation myth on the BSC chain, let's look at the underlying engine driving it all, BNB itself. Honestly, BNB's recent performance has been fierce. It quietly overtook both XRP and USDT to become the third largest cryptocurrency globally, trailing only Bitcoin and Ethereum. So why is it so strong? It really comes down to two things. One, its on-chain ecosystem is on fire, and two, its unique burn model. You can tell just by looking at the data. Daily transaction volume on BNB chain is more than 4 times what it was in the first quarter. Monthly active addresses are over 58 million, and its DEX volume has even surpassed Solana's. And then there's the burn. BNB has 2 burn mechanisms. One is an automatic quarterly burn, and the other is a real-time burn of a portion of the gas fees from on-chain transactions. This creates a positive feedback loop. The more active the chain, the more transactions, the more BNB gets burned, the lower the supply, and naturally, the remaining coins become more valuable. On top of that, they recently partnered with Chainlink to bring official US macroeconomic data on-chain. What does this mean? It means developers can now build more complex financial products on BNB chain. They're paving the way for institutional players. So BNB's breakthrough isn't just hype, it's backed by solid fundamentals. The market's perception of it has shifted from just an exchange token to the core asset of an independent public chain ecosystem. Okay, let's move on to the next story. In today's increasingly uncertain global economy, everyone's looking for a safe harbor, and recently, a very interesting phenomenon has emerged. Those crypto tokens backed by physical gold, like PAXG and XAUT, their total market cap just recently broke the $3 billion mark, with 24-hour trading volume soaring to $640 million. Why is this happening? It's simple. Risk-off sentiment is rising. Look, the spot price of gold just hit an all-time high, briefly breaking $4,000 an ounce. At the same time, the U.S. government is still in a shutdown over budget issues. Now on its 6th day, this political gridlock is making a lot of people worry about the credit of the US dollar. And the so-called debasement trade is back on. People are moving their money out of the fiat system, looking for assets that can hold their value, and this is where tokenized gold really shines. It's like a bridge. Physical gold is great, but it has poor liquidity and is hard to divide. Bitcoin, on the other hand, is too volatile. In fact, gold's performance has actually been better than Bitcoin's this year. Tokenized gold hits the sweet spot, combining the stability of gold with the efficiency of the blockchain. You can trade it 24/7, settle globally in an instant, and divide it into tiny fractions. So, the significance of this isn't just a number, it's a powerful validation of the RWA, real-world asset tokenization space, tested under real market pressure. It shows us that blockchain can not only create new things but also optimize old ones. As the global environment continues to be turbulent, the value of this bridge connecting traditional and digital finance is only going to grow. For our next story, let's shift our focus away from the market itself for a moment and look at the macro level. You might think a US government shutdown is something distant from our world of crypto trading. But this time, it's directly affecting our bottom line. The partial shutdown of the US federal government is now into its second week, and this political stalemate is hitting the brakes hard on the crypto industry's progress. The impact is being felt in two main areas, both of which are major events we've been eagerly anticipating. First, there's the market structure bill. How important is this bill? It's the one that's supposed to finally clarify who regulates digital assets, the SEC or the CFTC. This is the cornerstone for providing regulatory certainty to the entire industry. And the result? Key staffers on Capitol Hill have been furloughed. So all the drafting, negotiating, and voting has come to a halt. One expert analyzed that while this is a small setback, the probability of it passing by year-end has dropped from a previously high expectation to just 60%. Second, and what everyone is most concerned about, is the approval of spot ETFs. Market sentiment has been so high recently, largely because everyone was betting on the approval of ETFs for Litecoin, HBAR, and others. Analysts were even saying they were at the goal line, but with the government shutdown, the SEC is now operating with a skeleton crew just to handle emergencies. Do you think approving an ETF counts as an emergency? Of course not. So, all those applications are just sitting there, collecting dust. This doesn't just delay the outcome, it wastes precious political capital and a critical window of opportunity. With the 2026 midterm elections approaching, the politicians in Congress are busy with partisan battles. Who has the time to deal with our crypto matters? So you see, the development of our industry isn't always determined by technology and the market. A small ripple in macro politics can wash over us and bring everything to a standstill. Alright, next up, a piece of news that I think is a huge sigh of relief for the entire NFT space. For the longest time, the question of whether NFTs are securities has been like a sword hanging over everyone's head, and nobody knew when it would drop. Well, just recently, a US federal court handed down a landmark ruling. They dismissed a class action lawsuit against Yuga Labs, the parent company of Bored Ape Yacht Club, with the judge ruling directly that the BAYC NFT collection and the related ApeCoin do not meet the legal definition of a security. When I saw this news, my first reaction was that the entire NFT industry can finally breathe a little easier. The core of this lawsuit was the plaintiffs claiming that Yuga Labs' marketing led them to expect profits, and therefore these assets should be considered securities. But the judge applied the classic hobby test and found that the argument just didn't hold up. The judge highlighted two main points. First, there was no common enterprise in this case. Think about it. The vast majority of Bored Ape trades happen on third-party marketplaces like OpenSea, not an exchange run by Yuga Labs. Sure, Yuga gets a royalty, but that's not a direct legal tie. binding their financial fate to the NFT's price performance. Second, and most importantly, the judge found that Yuga Labs never explicitly promised profits. They always framed it as a digital collectible or a membership card to an exclusive club. Even though everyone who buys one might hope it appreciates in value, that's fundamentally the same as hoping a limited edition pair of sneakers will appreciate. The existence of market speculation doesn't automatically turn the item itself into a security. The significance of this ruling is massive. It's practically a compliance playbook for all NFT projects. It tells them how to operate to avoid securities risk. Emphasize the consumer and the utility aspects. Don't use words like investment return, and encourage trading on open third-party platforms. Of course, this doesn't mean all NFTs are in the clear. If a project openly promises to share revenue with holders, it will almost certainly still be treated as a security. But regardless, the Yuga Labs case has cleared one of the biggest legal hurdles for the vast majority of collection and community-focused NFT projects, and that is definitely a major positive for the long-term development of the market. This next story is really interesting, I think. Just as the entire market is craning its neck, glued to the SEC, waiting for a spot Bitcoin ETF approval, some folks on Wall Street are already playing a much wilder game. A global investment firm called Granite Shares has officially filed to launch a series of 3x leveraged cryptocurrency ETFs, tracking assets including Bitcoin, Ethereum, SOL, and XRP. When I saw this news, I felt like the market is quietly undergoing a significant divergence. See, on one hand, you have giants like BlackRock pushing hard for spot ETFs. Their goal is to bring in trillions of dollars of traditional capital in the simplest, most direct way possible. That's the mainstreaming track. But on the other hand, leveraged ETFs represent a completely different direction. This stuff isn't for you to buy and hold long term. It's a professional grade weapon for experienced, high risk tolerance day traders and hedge funds. It's a pure professionalization tool. The fact that these two very different paths are moving forward at the same time tells us something. The market is maturing in two dimensions simultaneously. It's catering to both the asset allocation needs of big money and the high-risk speculative demands of professional players. So what happens if these 3x leveraged ETFs actually get approved? The most direct impact will be a massive increase in short-term volatility. Leverage is the kind of thing that adds fuel to the fire when prices are rising, but kicks you when you're down. If the market starts to fall, those leveraged ETFs will be forced to liquidate positions to maintain their leverage ratios, which will intensify the selling pressure and could easily lead to a flash crash. So this filing from Granite Shares, while it might seem a bit ahead of its time before spot ETF is even approved, is a very strong signal. Wall Street doesn't just want to allocate to crypto as a new asset class. They're getting ready to bring their entire complex derivatives trading system over. The future market will be more institutional, more professional, and probably a lot more volatile. For our final story, let's take a look at the evolving global regulatory landscape. Dubai's recent moves have been very interesting. You could say they're using both the carrot and the stick, and they're doing it beautifully. The leading global digital asset custodian, BitGo, just announced it has successfully obtained a broker-dealer license from Dubai's Virtual Assets Regulatory Authority, or VARA. This might seem like a routine move, but the interesting context is that, just before this happened, VARA had fined 19 companies for operating without a license in the region. When you connect these two events, Dubai's strategy becomes crystal clear. They aren't trying to create a lax regulatory haven. On the contrary, they are using strict enforcement to increase the value of their licenses. Think about it. For a top-tier company like BitGo, which serves institutional clients globally, what do they need most? It's not a lawless environment. It's clear, stable, and predictable rules. By first clearing out the non-compliant players who are looking for loopholes and then granting a license to a top student like BitGo, Dubai is sending a powerful signal. It's telling the world, you can come play here, but you have to be a top-tier, rule-abiding player. This shows that the competition among global crypto hubs has entered a new phase. It's no longer about who is more friendly, but about who has higher quality regulation and a more robust system. Dubai's 1-2 punch here is a truly clever move. Alright, that brings us to the end of today's Web3 Daily Report. If you found this helpful, please remember to hit the like button to show your support. Every day, we sift through the Web3 world to bring you the most noteworthy core information that's closest to wealth. We hope that by curating this content, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've prepared exclusive registration links for major exchanges in the comments section below. These are high rebate offers we've secured for our fans, and we hope they can help you save some costs along the way. Let's stay rational, move forward steadily, and get rich slowly together in the Web3 world. May all of our friends' crypto assets grow steadily. We'll see you tomorrow.